Welcome back to Bunnex Investment Group. In this video, I'm going to teach you a reversal spotting strategy, which is basically going to be converted into a powerful trading strategy, which you can apply in your trading. So what are reversal points? These are points where the uptrend changes into a downtrend or vice versa. If we are trending to the upside, we will definitely find a point where the market will actually reach a top and reverse. So this is a point that we call a reversal. This is one of the most difficult way to trade, as everyone always advocate for trend trading. A lot of people want to trade in these particular points, but I am saying if you master the concepts that I'm going to review, it will simplify how to see these particular points. I'll give you only 3 actionable steps which you can follow to hit them with precision. So 1, 2, 3, you'll be able to actually catch these particular points with high precision. But I'm not promising a holy grail. This is an age and you need to practice discipline and patience to see it work for you. By age, I mean that it works on a probability, meaning out of 10 trades, probably you're going to have 7 or you're going to have 6 or even 5 out of 10. In some cases, the market is something that is not predictable. We might have a 10 out of 10 or a 9 out of 10, or sometimes we may actually be below half. So let's jump in without wasting much of our time. So what you will learn today consists of 3-step process, which is the steps that I'll give you for you to get the reversal point. Day of reversal determination, you'll be able to understand and to determine which day is going to reverse with what you have seen prior to the reversal. I'll actually give you market examples so that you'll be able to comprehend and be able to apply this particular strategy on your charts. Firstly, we need to talk of market structure, because if we do not talk about market structure, everything that we'll talk of will be gibberish. Market structure is the core of the market flow. We know that any asset class or any tradable instrument actually exhibits something like this. However, this is clean and this is simple, as I've seen as on this particular snippet. The market does not move this way every time. Sometimes it's actually chopping and sometimes it's actually very, very confusing. So when market structure breaks twice, we expect to see a market reversal. We mean that this is a shift and this is another shift, another shift. So whenever this second shift breaks the high of the first shift, we say it has broken structure once. And when the third shift breaks the high of the second shift, we say it has broken structure twice. When this happens, we actually start to anticipate a reversal at this particular point. However, this may be subjective in most cases. As I've said, the market does not always move like this in all cases. Hence, it requires the following steps. Step 1, every market structure shift must consist of a shift log. I'll explain this when we get to the charts. A shift log removes subjectivity to validate whether that shift is actually a valid shift or not. There should be 3 market structure shifts within one particular direction for us to determine a reversal point. The last shift must consist of a candlestick reversal pattern at its end for us to make an entry or to call that particular point a point of reversal. Let's now go on the charts. But before we do so, I want to personally invite you, who is on the other side of the screen, to join my one-on-one mentorship program. If you are serious about turning your trading into a powerful and sustainable source of income, this is for you. Use the link in the description box below. I only take a few students on a first-come, first-served basis. Let's jump over the charts. Alright, so this is GBP against CHF. You can see my default indicators are on my charts, which you can as well get. It's a template which I can provide you for free. From this particular, we can see that this is a low. And from that low, we can see a shift to the upside, meaning this is the first shift that was issued. First thing that we want to see has been satisfied. And when we say a shift log, we want to see these two indicators crossing each other. This is a 13 EMA period and it is applied to close, and this is a 50 EMA also applied to close. So we've said we need to see break of structure twice. So in this particular case, we had first shift and then a break of structure. So this is the first break of structure, and that first break of structure actually came from an impulse, or basically a shift, which is a lock. We've said these locks are necessary. This is a 1350 cross. From there, we can see the last break of structure, right? After having these break of structures and these shift locks, we can now say at the end we want to see a bearish candlestick reversal pattern. And in this particular case, we had this bearish engulfing M15 pattern that was issued. Entry at the closure of this particular candle, and we could actually take our profit at twice the risk that we have. Stop loss above the structure and take profit twice at or at 2R like that. This does not occur each and every day, but when it does, it will be actually of high probability. Here we can see there was a shift, a break of structure, but there was no third shift to the downside, meaning it was not actually proper. So we want to trade A plus, right? So here we can see there was a shift to the downside, which is this one. A shift lock was here. After this shift, we can see pullback, and then break of structure, another shift lock was issued, 1350 cross. Then after that, we can see another break of structure, right? And another shift lock was issued. At the end, what do we see? We can see this particular candlestick reversal pattern, which I call an engulfing bullish pattern, where we can see break of the low and then closure above the opening price of the previous candle. If you do not understand these particular type of candlestick reversal patterns, I have a video on this particular channel which talks of shift candles. You can actually refer to that. And we can see the market, although it consolidated, but it never went below this particular structural point, and then 2 to 1 was going to be satisfied. So basically that is how you will be trading these particular reversal points, only by looking for break of structure twice, with each shift or each impulse having a lock, and then at the end of the third impulse you have to see a candlestick reversal pattern like that. On that note, we've come to the end of our today's video. Thank you for watching. Like and subscribe, and I'll see you in the next one.